File section of Bloomberg, or of Canvas, I have a folder called Midterm Exam, which is now available. And in this folder is the midterm solution. So unless there's any specific questions about the midterm, basically the solution file is there. You can look at that, and then you're feel free to ask me questions. Yes?
Is there a rubric on how you're grading?
Basically, every section is going to be worth about a point. So there are 4 sections, 5 points. It's a point and a quarter
And
each.
is it like you don't get a match and you don't get that point? Or
You're going to have to get the match for each section plus the numbers. And they're going to basically check, for example, in CFI, they're going to check your free cash flow and your CFI, and then match. If you do, you get a 1 1/4 point.
So you still get like quarter.
You'll get partial credit if you get like part of it, right? But to get full credit, you'd have to have both numbers for each section. So for example, in TII, you'd have to get the NOPLAT right, you have to get the TII right. In TFI, you'll have to get the operating invested capital right and then TFI right, and they have to match. That's 1 1/4 point per section. Yeah.
For the homework, if you didn't get a question, like something right on the homework, but like you kind of showed out how you did it on the Excel sheet, you still get points for the Excel sheet.
Which homework are you referring to?
The one we just did, homework 2.
Homework 2. What was homework 2?
Tabs like this.
Oh, basically it's same thing. You have to get the numbers right and it has to match. Otherwise, partial credit.
Okay.
Okay, that's the way it's going to work. All right. So back to this. So again, once you look at the answer key, if you have any specific questions, please see me or the TAs about that. And then also, just coming up, Monday is your next group case, which is available now. It has to be turned in by Monday, so we're going to talk about that in a minute. And also starting Monday, for the next 5 classes, we're going to have in-class lectures, including today. So just be prepared for that going up to spring break, unless there's a snowstorm, which hard to talk about that when it's 80 degrees outside. But in any event, I would also say that you're going to need a computer for every class coming up. Because starting Monday, we're going to start to build an Excel model, which will become the valuation model we use for the semester and for your group projects. So it'll be a real model tied to Bloomberg. So what's going to happen over a period of 3 classes is I'm going to build it live in class. You're going to follow along. And you're going to turn in basically matching model to what I do. When we finish that, what you're going to then do is you're going to use that model to do individual valuations for homework assignments, and you're going to do it for your group project. So in a couple weeks, I'm going to give you an industry. You're going to pick a real company in that industry, and then you'll use that model to do the valuation on that company. That's going to be your end of semester project. All right. So just as a preview of what is coming up this semester. All right. So the other thing that is here is lecture note 4, which I posted, which we're going to go over in a few minutes and spend most of our time in class today covering. So you might want to get your hands on that file. So we talk about group project 2. So this is the file. It's called case.pdf, right? And I had it open in a previous class. So just as a reminder, this is going to be due Monday, 10 a.m. for all sections. And in addition, you have to turn in a peer review. So I got an email from a student who's still probably very upset with me, but he forgot to turn in his peer review for group project 1 on the PVH case, and he got a 0. All right, so I don't want that to happen to you. So just as a reminder, if you don't turn in a peer review, you don't get credit for the assignment. Okay, so you must turn in a peer review Monday in addition to your group turning in the assignment as behalf of the group. And the other question I got via email is they said, well, how do we do a peer review if we haven't turned in the grade? We haven't seen a grade yet for the group project. And remember that the peer review is not based on the outcome of the grade. The peer review is based on the level of effort that your team members put in to the group project. Okay, so that's what your peer review is based on. You have the Excel file, same one for PVH. You can continue using it. If you happen to have lost it, you can re-download the Excel file. Make sure you turn that in on Monday as well. The group case is actually going to be on this company, Nucor Steel. So just a little bit of background on this. A friend of mine, David Wessels, who's a Wharton professor now, one of the authors of the valuation book, I met him a long time ago when he was actually at McKinsey as an employee. And we were both training in McKinsey's analyst training program. And back then, they ran it 8 times a year. But what they do is they'd hire a bunch of undergrads, and they'd send them through this 4 to 5 week boot camp before they turn them loose on their corporate clients. And so part of the ATP is, I think they actually still use it, but they actually used to use this case to help them understand some financial principles. And David created this case. So this case is about Nucor, but it's actually not really about Nucor. It was actually about IBM, but they couldn't talk about an actual client. So David was asked, using the similar issues, to recreate the case using real world company. He chose Nucor that represented these issues, right? And that's what you're going to work on as a group. So a little context on the case. Basically, Nucor used to be called the Nuclear Corporation of America. They used to make nuclear power plants. But then they switched and they actually got into the steel business, and they were the first of the mini mills, and mini mills were basically recycled steel plants. So we had steel and iron around for 100 years, and what they found was that there was a lot of scrap steel in old buildings, and it was much cheaper and more efficient to remelt the iron and steel to make steel than it was to dig it out of the ground. So Nucor transformed, early disruptor of the steel industry, by basically introducing the recycled mills, which were called the mini mills and still are today. So at the time of this case, there were 2 players in the industry. There were the integrated players, your traditional steel companies, Bethlehem, US Steel, whoever, and there were the mini mills, which was primarily Nucor at the time. So where the case picks up is that basically Nucor is now thinking about building a second generation lower cost steel mill that they're going to spend $2.25 billion to fund. And so what your job is to do is to evaluate it on a DCF basis and an NPV to see if it makes sense to build the mill. But here's the thing, market dynamics matter because the steel industry is a commodity industry. So if we dump a bunch of new steel into the industry, the price is going to change, right? So when we do our DCF, we can't use the current price. We have to figure out what will be the new price when we put a bunch of new capacity into the industry, because that's going to be important for our cash flow forecast and our DCF. And eventually competitors are going to basically match what we do. They're going to build their own second generation mini mills. So when competitors show up with their own mills, that's also going to change the market dynamics, what happens to the price and the cash flows. And we have to anticipate that now when we do our DCF. So basically, the case is a lot about that. That to evaluate this, we have to look at the market, we have to think about the impacts of price changes in 2 periods of time. Period 1 is when we're the only game in town. Period 2 is 6 years later, when we anticipate competitors will come in with new mills, figure out the pricing impacts, figure out the cash flow impacts, and then do an NPV. We also have to think about the concept of cannibalization, because we actually have first generation mills which we're going to cannibalize our own sales on. And that has to be part of our NPV. 2 other things that I'll mention as hints to the case. You're going to want to do the case on a per ton basis, okay? Meaning because it's commodity, price per ton times number of tons equals revenue. So it's just easier to do everything on a per ton basis, right? Now, when you read the case, you'll see a number of worksheets, okay? There's 6 worksheets with a number of steps. At the top of each step are some questions. So what you have to turn in as a group are the completed worksheets and correctly, and at the top of the page a write-up answering the question at the top of every step. Okay, that is your group project due on Monday that you're going to complete and turn in. Okay, now second point I want to mention is that, by the way, when we give this to the ATP participants, basically it takes them about 1.5 hours to 2 hours to do the case with the worksheets. When we usually give this to them without the worksheets, it takes 8 hours. So I'm being nice to you guys. I'm actually giving you the worksheets. Okay, so it should go a lot faster and smoother as you do your group project work. All right. Final thing, and this is the second point I was going to make, is there's 2 terms in the case that I just want to make sure everybody's familiar with. The first one is called equilibrium. You'll see several references to the industry is in equilibrium. What that means is that in step 1, you're going to baseline the industry before we add the capacity, and that's where the industry is in equilibrium. And the idea is at that point, there's no economic incentive for somebody to leave, and there's no economic incentive for new capacity to enter. You have to explain why. Okay? And to answer steps 3 and 4, you have to explain how the industry gets back into equilibrium with the new plants. So that's one of the key pieces of the case. The second one is you'll see a reference to something called salvage value. Okay? You probably learned about salvage value in Finance 101, end of life, what's an asset worth? Well, salvage value in a more general term means what's the market value of my asset today. So in the context of the case, if I have a plant and I wanted to sell that plant today, the price I would get for selling that plant today is going to be called the salvage value. Okay? And you're going to see return on salvage value, and salvage value is key items through the case. That's what salvage value means. So giving you a heads up as you do the case. All right. So what I want to spend the majority of our time on today, so just working that as a group, and turn that in on Monday, subject to honor code. So only working within your group. All right, so back to this. Lecture 4. For the semester, the concept of EIC. All right, we've basically completed the idea of a historical industry analysis, understanding the industry environment that we're in. We're now moving to the second stage. Now that we've converted the financial statements, we want to be able to analyze these statements. All right, I can't go full screen here. So let me double check something. Trying to record this. All right, I want to make sure it's still recording. Okay, so unfortunately I can't go full screen because when I record and go full screen on this VGA monitor, it actually cuts off a lot of the screen. So you're going to have to look at this on your computer monitors on each of the computers in the room, otherwise you won't be able to read this. Concept of intrinsic value. Company's worth the sum of its future cash flows. That's where we're going next in valuation. But before we get there, second step of the class is going to look at historical performance. So the past doesn't predict the future, but the past informs the future. So now that we've converted the statements, and you guys just did the midterm in this, I'm going to talk to you about how to analyze the converted statements. And there will be 2 pieces of analysis we're going to do for every company the entire rest of the semester. This is also the majority of midterm 2 and an upcoming homework assignment. This is the process that you will be completing. So the first thing is going to be called an ROIC tree analysis. So starting next week, when we build the Excel valuation model, the model will automatically create this tree for any company. So you want to manually create it. It will be auto-generated based on real-world data. But nonetheless, this is part of the analysis that you will have to do. So using Merck's live data through 2016, they just reported 17, and I haven't updated it yet. So this is through 2016. We're going to talk today about the requirements for your assignments that you need to do as part of this ROIC tree analysis. So here's the idea, very high level. When we do valuation, best practice that you read in the book is basically that we forecast ratios. We don't forecast numbers, right? Because that's a better way to do evaluation. So for example, if a company has a constant gross margin or pretty close to constant gross margin, we can infer that that gross margin will stay similar going forward, and that gross margin will lead to a forecast of revenue and cost of goods sold. So rather than forecasting directly, we'll use the ratios to create our forecast. So again, looking historically at 5 to 6 years of ratios will help us when we do our forecast. It will also give us better insight into what is going on with a company. So when we do the ROIC trees, which you will do again for every company this semester, there are 3 things that drive ROIC. Always 3 things. You must always talk about these 3 things. If you don't, you're not going to get full credit. Okay? And this applies to manufacturing and service firms. It will not apply to banks because they're unique. And we're not covering bank valuation this semester. All right, so outside of financial services firms, this is the analysis you will do. So starting with Merck, EOY stands for end of year ROIC, as opposed to BOI, which is beginning of year ROIC. Okay, current NOPAT divided by current invested capital. So 5 years of historical data. When you actually do your assignment, you're going to care about the intervening years, but I'm just going to start by looking at the bookends. Okay, 2012 was the start, 2016 was the end. So in this class, you also must use numbers. If you answer a question without a corresponding numerical reference, the TAs are instructed to give you zeros on your assignment, no matter how many words you write. Okay, so again, for clarity, you can't just say Merck's ROIC worsened over 5 years. That is a meaningless statement because you have a 50-50 probability of being right without ever looking at anything, and you have no idea whether you actually are right or wrong. So I'm just telling you, we can't grade that. No matter how many words you write that out, that is meaningless. So here's how you must do the analysis. In 2012, Merck's end-of-year ROIC was 10.6%. In 2016, Merck's end-of-year ROIC was 9.5%. Over the 5 years, Merck's end-of-year ROIC after tax declined by 10.1%. Therefore, Merck's ROIC worsened over the last 5 years. That is a correct answer in this class, and a more informed comment on what's happening to Merck. Okay, so the first thing we know is Merck's ROIC over the last 5 years declined. Now, point of the analysis, why? There are 3 things that always explain the analysis. Now, in an earlier section of the class today, some people were getting pretty advanced and they were jumping to the micro things and they were getting it right. But what I'll recommend to you is you go in the order that I'm starting here with, from left to right, and walk through step by step, because until you get fully comfortable with these statements, this is a more informed way to start the process. So, number 1, what drives ROIC? Driver 1, tax rate. What is their historical tax rate? In 2012, Merck paid 27.9% of revenue as taxes. In 2016, Merck paid 15.4% of revenue as taxes. Every number on the sheet is normalized to $1 of sales, just so you're clear. So, that 44.8% decline in the tax rate, did that help or hurt Merck's ROIC over the 5 years? It helped? Yeah. They should actually have a higher ROIC because they're paying less in taxes. And that's the point, right? But that's not what happened. So obviously, their ROIC is declining not because they're paying less in taxes or more taxes. They're actually paying less in taxes, so something else is going on. But as a driver, they're paying less in taxes, and that is benefiting Merck. Therefore, look at the row above. The pre-tax ROIC, which is the performance of the actual operations, declined. In 2012, it was 14.7%. In 2016, it fell to 11.2%. They had a 23.4% decline in pre-tax ROIC. So if we want to understand what's going on with Merck, the reason for the decline in its ROIC had nothing to do with the tax rate. Matter of fact, the tax rate it paid should have helped Merck. It actually had to do with the underlying performance of the business itself, worsened over the last 5 years. Okay? Now, we go to drivers 2 and 3 of ROIC. Key value drivers. You watch videos on this, you read a textbook on this. Profitability times productivity equals ROIC. Profitability, operating margin. Operating margin is EBIT divided by sales. Productivity is invested capital divided by sales. Margin times productivity equals pre-tax ROIC. These are the second and third drivers of ROIC. Let's examine driver number 2. EBIT margin, operating margin. In 2012, Merck, as a percentage of sales, had a 19.5% operating margin. In 2016, their operating margin was 13.5%, a 31% decline in their operating margin. Did that help or hurt Merck's ROIC? It hurt it pretty dramatically. Okay, so that is actually going to probably be the primary reason why Merck's ROIC went down. A big drop in operating margin over the last 5 years. Driver number 3, productivity. Invested capital to sales. Remember, everything on this page is normalized per dollar of sales. So, the way to read this, in 2012, to generate $1 of sales, Merck spent $1.33 of invested capital. In 2016, to generate $1 of sales, Merck spent $1.20 of invested capital. Is that better or worse from a productivity standpoint? Is that better or worse? That's better. I'm spending the equivalent of 13 cents less per dollar of sales of capital to sell the same stuff. So basically, this negative 9.5% is an improvement of about a 10% productivity improvement, right? So I'm spending less capital to generate the same amount of sales. That should help my ROIC. Yes?
Can you explain the equation behind the percentage differences? Like, how are you getting those?
Just current year minus previous year divided by previous year. So that minus that divided by that.
Okay, thank you.
This is just percentage change. Everything else, that's what I put dollars in here, that's a percentage of sales. This is the percentage change. Okay? Okay. So, looking at these 3 drivers, why did Merck's ROIC drop? Was it productivity? Was it the tax rate? It's all margin. See, I know you didn't like the midterm exam. I know you don't like calculating those crazy statements, but this is the benefit. Is it very clearly lays out what's happening to a company, and it very clearly is going to help us do a walkthrough to understand what's happening in the company. That's why we did it. This is what's called the first level of analysis for the ROIC tree. Every time you're going to have to do this. Your next homework assignment is going to be doing this. Your midterm is going to be doing this. Okay? This is the first level of the walkthrough. The second level of the ROIC walkthrough is what drives the operating margin. What drives invested capital to sales. So, on the income statement, operating margin is EBIT divided by sales. 3 drivers off the income statement. Gross margin minus SG&A minus depreciation equals EBIT. So gross margin, SG&A is a percentage of sales, and depreciation are operating margin. So these 3 things explain the change in the operating margin. Now, here's the one caveat. Depreciation is a non-cash item. Typically, accountants include depreciation in cost of goods sold, right? We are taking depreciation out of cost of goods sold. So that gross margin is a modified gross margin, which does not include depreciation, right? We can do this because as a tool, Bloomberg is very helpful because they give us this data more granularly. So that gross margin is not the same gross margin you would see if you looked at the GAAP financial statements. Because GAAP would be revenue minus cost of goods sold. This is revenue minus cost of goods sold plus depreciation. Okay, so depreciation is not part of cost of goods sold. So it's more of a cash gross margin. Minus SG&A, which is typically a cash expense, gives us a cash EBITDA. Minus depreciation equals operating margin. So we're breaking out, the first two are the cash items, the third one is the non-cash item to explain the EBIT. So what's happening with Merck? Between 2012 and 2016, the gross margin went from 80 cents on the dollar to 78.8 cents on the dollar. Went down by about 1.2 cents per dollar of sales. Did that help or hurt the operating margin? 2012 to 2016. Did that help or hurt the operating margin? It hurt it. They're now making less operating margin because they have 1.2 cents less every time they sell the product. Spending on SG&A. In 2012, Merck spent 45.7% per dollar on SG&A. In 2016, they spent 51.6 cents per dollar on SG&A. Did that help or hurt their operating margin? Help or hurt? Hurt. In 2012, they spent 14.8 cents on depreciation. In 2016, 13.7. Help or hurt? $14.8 to $13.7. Help or hurt? They're spending less on depreciation per percentage per dollar sales. That helped. Okay, so we can explain kind of a walkthrough of what's happening to their operating margin. Their operating margin, I'll round off, went down from about 20 to 13.5, 19.5 to 13.5, went down by 6 cents, 6%, 600 basis points. Okay, why? Well, about 1% was a decline in gross margin, and about 5% was an increase in SG&A. That's what hurt Merck. That drop in profitability because of higher SG&A spend per dollar was the primary reason why after-tax ROIC went down at Merck. Clear, right in the data. Questions about that part of the level 2 analysis? Okay. Now, let's look at the balance sheet. Invested capital, which you just converted in TFI, is the balance sheet. All right? There are 3 portions of invested capital and buckets. They're on this tab. Working capital, net PP&E, goodwill, and intangibles. These 3 things are invested capital. Therefore, working capital plus PP&E plus intangibles equals invested capital to sales. These are the drivers. Right? Just a few minutes ago, we said that Merck's productivity improved because they went from spending $1.33 of capital to generate $1 of sales to only spending $1.20 of capital to generate $1 of sales. They're more efficient. Let's be more granular. This is the second level of analysis. Working capital is a percentage of sales. They went from spending 11.9 cents on working capital per dollar of sales to 1.1 cents per dollar of sales. Is that better or worse from a productivity standpoint? That's a whole lot better. They're spending 10 cents less per dollar of sales on working capital. Everybody see that? Now, last section, somebody said, but isn't that bad? And I would say in an accounting class, you might consider that to be bad because accountants like to have working capital. But finance people don't like to have working capital because I have to borrow to have the inventory. I have to borrow to have the unpaid bills, and that costs me money. So from a cash flow standpoint, less working capital is actually better to your ROIC. Okay? So basically, working capital to sales helped ROIC. They got 10 cents of improvement per dollar of sales from working capital. Net PP&E. $33.9 was spent on PP&E in 2012 per dollar of sales. Now they're spending 30 cents per dollar of sales. Better or worse? Is this better or worse in terms of plant utilization? It's better. They spent 87 cents on intangibles in 2012. They spent 89 cents in intangibles on 2016. Did they do acquisitions? This is goodwill and intangibles. Did Merck do acquisitions? Because they went from 87 cents intangibles to 89 cents intangibles. Why do intangibles go up? You had to purchase more intangibles. So when I asked, did they do some acquisitions? What's the answer to that question? Yes, they did. Did they do a lot of acquisitions? 2 cents. So their productivity is worsened by 2 cents per dollar through purchasing some intangibles. But that was more than offset by knocking out 10 cents per dollar on working capital and 3 cents per dollar on facilities. Yes?
Are there any other ways to increase or decrease intangibles?
The only way to increase intangibles is to acquire it. Under accounting rules, you accountants do not let us put intangibles on a balance sheet that we build because they're too hard to value. The only way intangibles show up is if they're acquired, because when you put a purchase price on somebody else's intangibles, you assign a value, the difference between the pay and the value of what they spent. So intangibles are purchased. The only way intangibles decrease is if you sell the asset, or they now do what's called an impairment test. They used to amortize intangibles like depreciation, but they stopped that, and now they just impair intangibles, which basically means they write it down. Okay? However, impairment of an intangible, which is a non-cash item, is not tax deductible. Impairment of an intangible is not tax deductible. So a decline in intangibles to sales doesn't really impact cash flow. An increase in intangible sales has to impact cash flow because that's the only way you can increase it. You got to buy it. Okay? So just a word to the wise on intangibles. So Merck spent 2 cents more. That was a cash flow. Okay? But here's the real story of the ROIC tree. Merck's end of year ROIC went from 10.6% in 2012 to 9.5% in 2016, a 10% decline. The tax rate went from 27.9 to 15.4 during that period of time, a 45% decline, which should have helped their ROIC, but unfortunately, the underlying performance of their operation worsened because the pre-tax ROIC went from 14.7 to 11.2. As we look at the drivers of pre-tax ROIC, the operating margin went from 19.5 cents in 2012 to 13.5% in 2016, primarily as a result of a decline in gross margin from 80 to 79, and more importantly, an increase in SG&A spend from 46 to 52. Okay? The productivity of the underlying assets improved because they went from spending $1.33 in invested capital to $1.20, and they improved their balance sheet across the board. Working capital went from 11.9 to 1. PP&E to sales went from 34 to 30. And intangibles did go up from 87 to 89, but the improvement in working capital and intangibles basically offset the decline, working capital and PP&E offset the decline in productivity by the increased intangibles. To summarize, the primary reason why the operating ROIC dropped after tax was the increase in SG&A spend. That is an A+ answer. Okay? If I had said the exact same thing without using numbers, you'd get a 0. Must use numbers. But flip it around. By using numbers, I packed a lot in there. There's a lot going on at Merck, and I'm already starting to understand this. Questions? Questions about Merck? And their ROC. Yes?
I don't really get how invested capital can be higher than sales and they're still making money.
So, for invested capital to sales and how they're making money. What's your name?
Andrew?
Andrew. I hire Andrew to work for me. I pay Andrew $60,000 a year coming out as an undergrad. How much of that does that cost me on my consulting firm P&L? $60,000. I buy $60,000 worth of network equipment. How much does that cost me on my P&L? No, it doesn't cost me $60,000. It's going to be spread out over time. So, 10-year depreciation line. How much does $60,000 of equipment cost me today? $6,000. Right? That's how. Because if I buy a lot of long-term capital, more than $1 of sales, because I'm spreading it out over 10 to 20 years, every year, it's not as big of an impact. But to the company, they still outlaid the cash and had to borrow the money, and it's going to show up as a lot of invested capital to sales. That's what you're seeing. Good question, though. These are the important questions to ask because you guys really need to understand what this stuff means. Okay, you did it in accounting, but here we're actually trying to apply it to the real world. But that's actually a good question because that gives you an interesting insight. Other questions about this? All right, here's one other piece of context you don't see, but is interesting to know. Here's the rest of the story. When you do this in the model, you're going to have another tab with the historical financial statements. So let's just put up to Merck. Here's Merck. Here, FA. Here are their income statements, historically. What do you notice between 2012 and 2016? Look at revenue. What was revenue in 2012? $47 billion. What was revenue in 2016? 39.8. They basically saw a $7 billion decline in revenue over that period of time. So, with that additional piece of information, why do you think SG&A as a percentage of sales spiked? Why did SG&A as a percentage of sales spike?
The sales went down while it stayed the same.
Exactly. I'm spending a lot to try and, to some degree offset my decline in sales. Or I just have people that I just can't cut fast enough as the revenue declines. Therefore, as a percentage of sales, it's spiking. I have some more context. Just out of curiosity, if sales went down by $7 billion, plants are a fixed or a variable cost? Fixed cost. Did we see the same thing in PP&E? What happened to PP&E as a percentage of sales between 12 and 16?
Went down.
How does that happen if plants are usually fixed cost and sales go down by $7 billion? How do we spend less on plants over 7 years? What had to have happened? They either sold or shut them down. So this is what I mean by once you do the analytics, there's a lot of information about a company that's hidden in these financial statements that I can now go to Merck knowing they sold or shut down plants without even talking to the company. Right? By the way, I work with Merck, so I'll give you the answer. They cut a bunch of plants. Right? Because two things happened. One, the reason why sales went down, they had a bunch of drugs whose patent expired and generics took over. Well, that was bad for Merck. But that's the next thing. I don't need a bunch of plants if I'm not producing the drugs, so I shut them down, and that's actually what they've been doing in their supply chain, right? Now, they have some drugs which are coming on the market that aren't here yet, so they're kind of going through this little bit of a ditch as a company where they have not a lot of growth, and then they're kind of struggling until they do better. But nonetheless, we see that in the numbers, right? The story will start to make sense. By the way, that story, you would have figured out when you did your EIC analysis, because that's what the analysts were talking about during this entire period of time. So everything I told you is public information. Read the analyst reports, read the transcripts, read the others. This is why you did the PVH analysis. So I'm saying is that now that we're starting to understand Merck, we'll be much better prepared when we do our valuation. I want you to do the same thing. I'm going to give you a few minutes. Look at slide 4, Erickson. Do Erickson. Practice. Give you a couple minutes to look at this, and then we're going to walk through it. Okay? So, Erickson, just as an FYI, basically makes back-end equipment for cell phone networks. So any call that you make on your cell phone through T-Mobile, Verizon, AT&T, or Sprint, is going to hit the equipment of somebody like a Nokia or an Ericsson on the back end. Okay, so they make that back end cell tower stuff. So, analyze Ericsson over 5 years. Go. All right, so in the interest of time, what can we say about Ericsson? Let's walk the same process through Ericsson that we did with Merck. So yeah, go ahead.
So the first thing that I noticed was that the cash tax rate increased substantially.
Okay.
And so you can see it was the 27% increase in the last 5 years. And then their pre-tax ROIC.
So let me stop you.
Okay.
Just to do best practice or required practice, what was the tax rate in 2012?
41.7%.
And in 2016, you don't want to look at the screen in front of you.
There you go. 52.9%.
Okay. So when you say increase substantially, just make sure you include the numbers 41.7 to 52.9 in the conversation. Okay. But I think you're right. And by the way, 53% seems like a lot of taxes. Like we complain about taxes in this country. That's a lot of taxes. All right. But nonetheless, tax rate hurt them. But you're jumping ahead, and just to make sure everybody's following along, could you go back one step to the first end of your ROIC?
Oh, yeah. So we can see that in the last 5 years, ROIC has decreased from 14.5% to 2.5%,
Yep.
which is an 82.9% decrease. So ROIC has obviously decreased.
But, and I know we didn't do this with Merck, but eventually, what's interesting about 15 and 16?
They jumped like a lot.
Drop like a lot.
Yeah, drop like a lot. Yeah, I haven't done the math in my head.
That's okay. Forget the percentage, but just the point is, almost all of that drop occurred between 15 and 16. And that's what I mean by eventually. I want you to also talk about the intermediate years, because that's what's interesting. What's interesting about Ericsson wasn't just the 5-year decline. What's interesting about Ericsson is the cliff they went off in 15, between 15 and 16. Something really happened to them during that year. Obviously, look at these numbers, we don't know, but we're going to want to go find out. Yeah.
You can also see, like, looking at intermediate years, 2015 and 2016 for the cash tax rate,
Yep.
it jumped a lot too, from 31.2 to 52.9, which is a pretty big jump.
That's right.
For a tax rate.
So what's probably happening here, if I had to guess, is if I saw a big decline in my income, which we're probably going to see in the operating income, and I had to pay some of my deferred taxes, it's doing some crazy things with my cash tax rate. Okay? Because I'm not making as much money, I'm not paying as many taxes, but if I'm paying old deferred taxes, tax as a percentage of the lower income is a high percentage. It's probably what's happening here, but that would require additional insight. Okay? But a good note of what was happening there. Okay, so we know that the tax rate went up. That hurt them. What about the pre-tax ROIC performance? Is that good or bad? Yeah.
It's really bad. It went from 24.8% all the way down to 2%.
So which one do you think hurt them more? Was it the increase in taxes or the decrease in pre-tax? It was the pre-tax. That's really Ericsson's problem. Yeah, they're paying a little bit more in taxes, but really what's killing them is the big operating performance hit. All right? So why don't you continue on? Talk to me about drivers 2 and 3. Margin or productivity? What were their hits?
So productivity actually seemed to, so the operating margin decreased a lot as well, from 0.097 to 0.028.
Okay.
It's a 71% drop, which is also not good, which probably explains why their pre-tax fell so much.
Yep.
And then looking at invested capital, it went up from 393 to 535, which is like good, but doesn't like offset issues they have.
Yeah, unlike Merck, which was pretty much the story of one metric, the operating margin, Ericsson, all three are flashing red. And it's a really good insight there, good analysis. He did exactly right, but that's the point. Worsening productivity, worsening margin, higher tax rate. But he also identified that the biggest challenge is that drop in operating margin. That hit them the most. But all three were working against them. Okay? And just as a follow-up, when did the margin really get bad? Did it get bad straight line over time? When did it really get bad, the operating margin? Between 15 and 16. Okay? When did the productivity worsen? Invested capital sales. Did it just get a little worse every year? No, mostly between 15 and 16. So what I'm telling you is, if you look at this, it kind of blipped in 14, it got even worse in 16, but something's really going on in 15 to 16 with Ericsson that we'd want to know more about. Okay? What about the second level? Somebody else. Why did this operating margin get so bad? What happened on their income statement that caused the operating margin to get so bad? Somebody else. These three items. Because remember, this minus this minus this is this. Yeah.
It's similar to Merck in the sense that the SG&A went from it went from 22 cents per dollar of sales to 27 cents per dollar of sales, increasing by 1.1% over that period of time. And also the gross margin went down, which also became depreciation decreased too by 4.8%. But it wasn't enough to offset the increase in SG&A.
Yeah, so really it was the SG&A that was a big driver of the drop in gross margin. Good linkage between the two, and that's exactly right. That's where I want you to start to associate. Okay, since you're doing a great job, why don't you do the balance sheet one too? So what would you say about the balance sheet and the productivity numbers, the bottom three? Because remember, those three numbers add up to invested capital. Yeah, you. Yeah. I know she wasn't prepared for this one, but it's,
Spending more money on working capital.
okay.
55.1%.
Because it went from,
It went from 12 cents per dollar of sales to 19 cents per dollar of sales.
okay,
2016.
great. What about PP&E?
So you're spending more money on PP&E, which is also not great. It went from about 5 cents per dollar of sales to 7 cents, or almost 8 cents per dollar of sales.
And what about intangibles?
So intangibles increased probably means that they acquired something within the time from 2012 to 2016. Looks like in between 2015 and 2016 they also acquired something increased 22.5%, which is
Also hurting their ROIC because they're less productive. All three were working against them. So really, it was an overall decline in productivity, and operating margin really suffered, particularly because they're spending a lot more in SG&A without the corresponding increase in sales. Right? Again, we don't have this, but I'll give you one additional piece of context. If I look at Ericsson, and I look at their actual income statement, because you would have seen this when you did the conversion, this is their revenue. Now, I'll put this in dollars as opposed to krona. But their revenue went from 34 to 26. In fact, they just reported 17. It's down to 24. Okay, so big drop in revenue. So we identified something bad happened between 15 and 16. What bad happened is they lost about $3 billion of revenue in U.S. dollars equivalent. Okay, so here's just a little context for you. So what's coming is what's called 5G. You guys familiar with 5G? Heard of 5G? It's going to be an increase in network speed of cell phones by a factor of 100. Right? So imagine 4 gigabits per second to your cell phone. And for gamers out there, 3 millisecond latency. So really fast. Okay? We don't have that today. The challenge is Ericsson and Nokia and the other network vendors were ready in 2016 to launch 5G. But the carriers decided to postpone it. Okay? Because what's happening is they don't want to spend tens of billions of dollars upgrading to 5G because they still haven't paid off 4G. And if you paid attention, we're in a price war right now, right? So the prospect of spending a whole bunch of more money in a price war, and we haven't even paid off the old stuff, doesn't excite the carriers. So as a result, the launch has been delayed. Okay, so it's 2018. We're talking probably 2020 before you realistically can buy a 5G handset that will be truly 5G. And that's the problem. Is now, instead of selling all the stuff they built the money for to sell, they basically have to sell the old stuff that nobody really wants because nobody was ready to buy the new stuff. And their upgrade cycle has been postponed. And may be more drawn out than people think. And so that is the inherent challenge you're seeing with their numbers. That context you have gotten in the EIC. That would have been the industry analysis. But nonetheless, we understand the Ericsson story and their ROIC. Okay. The final statement that you're going to do is let's talk about, for about the last 10 minutes, go back to Merck, the CFI. Okay. You guys just converted the CFI. So here is a converted CFI. Real data for Merck over this 5-year period of time. Make it a little bit smaller. Now, when we go through CFI, there are, as you know in your conversions, there are 4 sections of CFI. Operating, which is free cash flow. Non-operating, which gets you to CFI, debt, and equity. When you do the CFI analysis, you must explain all 4 sections. Okay? But you're going to start with free cash flow. What is, and just for simplicity, the total sums up the 5 years. Okay? So for simplicity, let's just focus in the interest of time on the total column. Eventually you have to talk about the change over 5 years, but right now let's just look at the total. What is Merck's free cash flow over the 5 years? What's the number that it totals up to? $45,420,000,000. If you had to explain that to a marketing major, what does 45,420 mean? They're like, hey, I heard Merck had $45 billion of free cash flow. What does that mean? if you got asked that question by one of your friends who's a marketing major, what would you tell them? Yeah.
They have that much cash available.
Okay. How'd they generate that? After what?
All their that's how much cash they generate from all their operations.
Yeah.
And that's how much money they generate from their operations, from their investing and from their financing.
Yeah, after all of the investment. Ignore the word financing because financing is not part of free cash flow. But otherwise, most of that statement is correct. So that's the point. I generated $45 billion of cash from operations after I made all my investments. They boatload of money. So here's what I want you to do. I always want you to start a free cash flow, and I want you to look at that number, and I want you to decide whether it's positive or negative, because that's going to inform how you analyze the statement. If the $45 billion of cash flow is positive, then guess what? What'd they do with the money? So the rest of your analysis is where'd the money go? Did they put it into non-operating activities? Did they use it to pay off debt? Did they use it to pay off shareholders? Or if a company has negative free cash flow, where did the money come from? Did they get it from non-operating cash flows? Did they get it from debt? Did they get it from equity? So free cash flow is important because not only is it key to value, but it sets up how you're going to think about the analysis of the company. So again, if positive, where did it go? If negative, where did it come from? Then for operating, why positive? Merck generated from the income statement $58.15 billion of gross cash flow. Merck reinvested in its balance sheet, gross investment, $23.7 billion. That was a 41% reinvestment rate. What's their payout rate? If the investment rate is 41%, what's the payout rate? 59. That's what we're going to go track. Where'd they pay it at? But they reinvest 41% on average for every dollar of revenue. Now, here is a rule of thumb. We talked about depreciation earlier. Depreciation is typically straight line. On GAAP, it's straight line. On a GAAP statement, it's straight line, which means if I have a 20-year plant, 5% a year, okay, is depreciation. So here's a rule of thumb. I need to spend depreciation to tread water, right? If I'm not spending my depreciation, my plant is going to crumble. So I need to at least spend depreciation, else I'm not going to be able to maintain what I got. That's a rule of thumb over time in finance. If I'm growing, I should be spending more than depreciation. If I'm shrinking, I'm probably going to spend less than depreciation. What is Merck's depreciation over the 5 years? How much depreciation do they have? What's the number? Total column. 32.4 billion. How much CapEx over 5 years?
28 billion.
What does that tell you? Was Merck trying to grow? If they were trying to grow, they should have spent more than how much?
32.
They only spent 28. We already know by looking at the cash flows they're not growing. Here's a signaling effect. Tell me what you think Merck's growth rate is going to be in 2017. What's their depreciation in 2016? And how much CapEx they do in 2016? You think they're going to grow a lot in 2017? This is what I mean by signals. See, by looking at the cash flows, if Merck really was going to grow next year, they'd probably be spending this year to grow next year on their plants after uninvesting for the last 5. So I didn't have to ask them what their sales forecast for next year is. They told me based on what they're doing with their CapEx. Because unless they do a major acquisition of a plant, they're just not spending even depreciation, so they're not expecting a lot of growth. Versus if they had spent $10 billion on CapEx, well now I think something's about to change. So that's what I'm saying is there's a lot of information here that's presented in a much easier to understand format now that we've converted these statements. Let's continue on. What do I do with the $45 billion? Well, when I look at the non-operating cash flows, I did about $2 billion there, and I ended up with 43.3 of CFI. Okay, so what happened in the non-operating activities? Well, I spent about $10.8 billion on non-operating assets, but I also had some gains of about $7.7 billion, and cash decreased by $466 million. So I generated $45 billion in cash, and my cash balance actually went down by $500 million. So what did they do with the $43 billion of cash flow that they distributed to investors? How did it get distributed? Let's look at the debt. $2.8 billion was paid in interest expense. Makes sense. Got to pay interest on the debt that I have. They increased their debt by $7 billion. Wait a minute. Why would they do that? Does Merck need to borrow $7 billion worth of debt? Does Merck need to borrow $7 billion worth of debt? By the way, this was a midterm question last year. Yes or no? No. How can I say that with certainty? Yes.
They're not trying to grow.
I'm sorry?
They're not trying to grow, so they don't need to.
I can't say that with certainty. There's a number on here that tells me with certainty they didn't need to borrow this. This was purely discretionary.
The free cash flow?
Their free cash flow. If I have $45 billion of cash after investment and acquisitions left, I don't need to borrow another $7 billion. Right? So that's the point. They're borrowing it probably because we were at an all-time low of interest rates, and why not take advantage of that? Okay? Well, let's continue on. What did they do with the rest of the cash? Shareholders, $26 billion of dividends, $24 billion of share repurchase. What does 26 plus 24 add up to? $50 billion of cash to the shareholders. How much CFI did they have? Where'd they get the 7? So what'd they use the debt for? Pay the shareholders. No matter what the company says, we know that's why they did it. They didn't use this for an acquisition. They used it to buy back stock. I'm not saying I blame Merck for doing it, but we clearly see that's the reason that they did it. They didn't use it for CapEx. They didn't use it for R&D. They used it for share repurchase. Does everybody see how we can make that conclusion? Very straightforward in your CFI. Okay? Now, here's the thing. Why do you think they bought back so much stock? Because when people say they buy back stock, they basically say, I have confidence in my company, and that's just bullshit. It's marketing bullshit. Don't listen to it. Listen to it because it's happy talk, but it's not true, right? Because here's the point. If you had confidence in your company, you'd be investing in plant, R&D, people to grow your assets. If you're taking cash and giving it to somebody to use somewhere else at another company, that's not confidence in your company. That's giving them money to go spend it someplace else. Okay? So let's be real about why companies buy back stock. Right? Why they're buying back stock is because on an incremental dollar, I don't have $45 billion of good uses inside my company, and so I'm better off giving it to you to go use someplace else than putting it in because I don't have the revenue and I don't have good use for cash. So after I do well, what do I do with my $45 billion? It's better to give it to you than to be wasteful if I'm going to throw a bunch of money at sales that aren't going to grow. That's why I bought back the stock. And I'm going to be rewarded for that versus a bad decision. Yes?
Wouldn't they also want to do that to lower their WACC?
Well, I'm not saying that that couldn't have been capital structure, change debt for equity, discretionary choice. Absolutely. We can see that that's actually what's happening here. Another point, let me give you the third one. For publicly traded CEOs, most of their compensation is going to come from incentives. The two most common incentives that CEOs get are increasing EPS and higher share price. Why does stock buybacks help your EPS? If my earnings stay the same and I buy back my stock, what happens to my earnings per share? Exactly. What's happening to Merck's profitability?
Your shares outstanding is going down, so your earnings per share is going to go up artificially.
Exactly. What did we just see? Merck is struggling, yet Merck's EPS is growing. So what they're doing is they're basically manipulating their share count so it actually looks like their EPS is growing, even though they're having some tough times. So they can actually say, and a lot of companies will say, we're going to grow operating earnings 3%, we're going to grow EPS 6%. The way the EPS grows 6%, they buy back shares. All right? So from a shareholder standpoint, sure, my share price went up. But let's look at a Merck stock price chart. Here's Merck's stock price over the last 5 years. And if you look at the last 4 years, it's been pretty darn flat. So what happens if Merck doesn't buy back $24 billion worth of shares? What happens to the stock price? It goes down. By the way, here's the other thing. The other thing I'm going to be measured on is my stock price. So that's the point. If I'm having underlying trouble in my business, less share count helps my stock price. So I'm not saying it was the right thing to do for Merck. It absolutely was. I don't have a good use, so I'm rewarding my shareholders for past performance. That's not confidence in my future. It's confidence in the fact that I'm giving you cash because I'm smart enough to know it would be wasteful to put it back in my business. And here's the point. If I make good decisions now, when I do have Keytruda as the wonder drug that is ramping up and I need the cash back, you're going to be willing to give it to me because you think I'm a good steward of your cash flow. See, that's why I'm buying it back, right? It's not confidence in the company. And people say that, but if you really think about it, it's a distribution of cash to an investor who's going to take the cash and go someplace else. How's that investing in your company, right? So again, people will use these words, but that's what we said. When you really look at the CFI, this is what's going on with a company. And this is the analysis that we're going to continue to do throughout the semester. This was practice, but very soon, this is going to be your homework assignment. So essentially getting used to the analytics. But this is also why you convert the statements, because we get a lot of insight into what's going on with these companies by basically looking at these converted statements, and it's a much more straightforward analysis, which is repeatable across companies, particularly when we do competitive benchmarking. So again, introducing you to a new way of looking at the companies. So this is the payoff for the midterm, which I know sucked for you. So here we are. End of class, Monday, group project number 2, do the new core case. Make sure you turn that in as a group. One person turn it in by Monday, 10 a.m. Each of you turn in your peer evaluations by 10 a.m. We'll discuss that in class. Make sure you have a computer or laptop to use next week, because then we're going to start building the valuation model that comes out of these statements. See you guys on Monday. Enjoy the warm day.